Hi, everyone. What I would like to do is spend some time together to discuss this particular topic, which is earnings per share or EPS, right, as referred to or represented by Ind AS 33. Friends, we would have heard this term before, and in some context or the other, and the easiest way to understand or interpret EPS is basically it's a return per share, and that's how you start referring to the words earnings here. Okay, returns doesn't mean that you have to pay dividend, right? But it's the profitability part. That's something which is the key. And let's of course also appreciate the fact that any return, the higher the return is, the better it is for the users or for the company or for the shareholders, of course. And that is where this standard is driven on, right? Since we are talking about the return per share, and we also understand in general that higher the return, better it is. Somewhere, this standard expects us to talk about how is this return generated? How do we look at the generation of return from an EPS perspective? Okay, say I'm talking about, let's say, two companies, company X and company Y. Okay, now let us say that the total earnings of these two companies are 10,000 and 20,000 respectively. And let us say the number of shares are 5,000 and 10,000. Okay. So while in totality, company Y appears to be a larger company because it is creating more profit. All right. What is important to understand is that when you look at the earnings per share, I'm taking a simple division of this. Whatever is my total profit divided by number of shares. This is 2, and this is also 2. Okay. So how should a reader of financial statements read it or analyze this number? Okay. The total profit does not really matter a lot. It matters, of course, but then you start looking at it as a return on the number of shares. And in this case, if this return is same between X and Y, yes, scale wise, probably company Y is doing better, but in terms of the return per share, it is no different from company X. You would probably want to look at more parameters, more financial aspects to eventually decide which company is performing better or which company is expected to generate more returns for you. Okay, but then on the EPS front, we assess that or we observe that they appear or they look the same. Okay, now that is one aspect where it started looking at the reference of generation of return. Okay, the other aspect importantly, which is to be understood, is that fundamentally the standard says that, or the basis on which the standard is built is that return or profit is a function of capital, right? It is just an extension of the same concept that we have referred to as generation of return, but we want to look at it in a more formal way, more fundamental way, where we say that this profit is a function of capital. So in an ideal scenario, we are saying that if there is more capital, okay, if the capital is more or the money invested is more, ideally speaking, the return should also be more, like in the case that we have discussed just a minute ago. If company Y is having 10,000 shares, it has received money by issue of 10,000 shares, for example, and it is making a profit of 20,000, it is expected to make a higher profit when compared with, let's say, company X in this given case, where it has only issued, let's say, 5,000 shares. Okay. So in a way, the money that is received from the issuance of shares, right? Since we are referring to earnings per share, we are focusing purely on the return from the share side only. Okay. So when we say that, we are looking at the number of shares in this case, okay, which is 5,000, and company X is able to create or generate a profit of 10,000. This function or this relationship between the profitability and the capital, right, which is number of shares or the money received by issue of number of shares, it fills that gap, or it meets that perspective. And that's what we're saying. It does not make a difference purely on an earnings per shares perspective. It does not make a difference whether you want to invest in company Y or you want to invest in company X. Okay. Now, versus this scenario, if I were to, let's say, take another two sets of companies, company A and company B, and we are saying that the profit or the earnings is, let's say, 20,000 and 20,000, and let's say the number of shares are 10,000 and 8,000. And of course, we calculate this EPS, right? This is 2 times, this is 2.5 times, right? Which one of these two companies would you prefer? Which companies would you prefer for investment purposes, right? Purely on the EPS context, we would want to probably invest in. We would certainly want to invest in company B because the earnings per share is higher. Okay. Again, the money received by issuance of 8,000 shares is generating, in the given case, of course, the same profit as the money received by issue of 10,000 shares for company A. So let's say we are talking about for company B here, right? We are investing whatever money that we are getting by issue of 8,000 shares, right? We are able to generate the same profit, if effectively a higher earnings per share, versus, of course, let's say if company A is a competitor, right? And that is how you start looking at it, that the profit, right, is a function of money. The profit is a function of the money invested, which is represented through, or which is represented by the number of shares issued. Okay, so the one thing that you want to remember is that profit is a function of money, or of what's a function of capital in this case. Okay, so that is one angle, that is one aspect that you want to remember. Okay, so essentially, higher the return, better it is. Higher the EPS, better it is. That's the way you want to, of course, read it throughout this particular standard. But then it's not that straightforward. It is not very straightforward from a measurement perspective, because we may argue that what if the shares are partly paid? How do you deal with that scenario? Okay, what if shares are issued for free, maybe through a bonus, maybe through a stock split, maybe there is an issue of warrants, for example, right? So this particular standard would want us to consider all these things, right? There is also an aspect of, importantly, something called as a basic EPS and a diluted EPS, right? We'll be spending a lot of time talking about these two aspects. A diluted EPS, just to share the perspective, is basically that you are issuing something today, you are getting into a contract, for example, today wherein you are raising money, right? For example, you're raising money, but the instrument through which you are raising money is not a share today, right? But it might become, or it will become a share in future. Okay. For example, a convertible bond. Okay. It simply suggests that you have raised money today itself, but it is not a share, which probably means it's a liability. But then the liability also has a feature that it has a potential of becoming a share in future, right? It has a potential of becoming a share in future. And if it is becoming a share in future, the denominator of that EPS, right? The calculation of EPS is basically my total profit or total earnings divided by number of shares, in a very simplistic language. So in future, if these number of shares increase, that will dilute the earnings per share. And that is the reason why we use the reference or the term diluted EPS. Okay. So if that is a scenario, then how is the reporting of EPS done in such circumstances? Okay. Also, the standard expects us to talk about, it covers, of course, what if there is a discontinued operation, right? You are doing some business today, but it meets the criteria of a discontinued operation, which means from this operation, whatever profits you are making, that may not arise in future. So should you adjust your profitability for the calculation of that EPS is also being talked about as a part of the conversation, right? And finally, we also want to address the concept of EPS in the separate financial statements and consolidated financial statements. We have to calculate the EPS not just for the entity on a standalone basis, on the basis of the standalone profit and loss account, but we also would be required to calculate the earnings per share at a consolidated level from a group's perspective, right? So these are all these aspects that we intend to cover in our discussion for this topic, which is Ind AS 33. Okay. The one thing that you want to remember, higher the return, better it is. It suggests a better performance by the business. And the one aspect that you want to always bear in mind, and we're going to use that reference time and again, that profit is a function of money, right? Higher the money, more the expectation of profit. It's not a rule, but that's the expectation. And on that fundamental basis, this entire standard is built. So we'll be discussing all these aspects in the discussions to follow, in the concepts to follow. So what we want to address while we discuss this particular standard, we want to talk about what is the meaning of this EPS and what is the objective behind the calculation. We have briefly talked about that, right? And then the types of EPS, the basic EPS and diluted EPS. How do we measure that, right? There would be a more detailed reference of how do you calculate the profit for EPS purposes. What is that amount of profit? And what are those number of shares? Okay. And then different scenarios. We would be referring to, for example, I just take the next step here, we'll be referring to something called as a bonus issue. We'll be talking about stock split. We'll be talking about right issue, for example, right? And then there are some aspects of diluted EPS. So we'll refer to all these aspects when we are discussing how to calculate the basic EPS and diluted EPS under different scenarios. Okay. There's also a reference of something called as a potential ordinary shares or potential shares, or to the extent of some context discussion on contingently convertible shares. And finally, the presentation and disclosure requirements of this particular standard. Okay, so that's where this entire conversation is going to be driven. From an examination standpoint, we don't really see a lot of testing done, but it's an important topic from a conceptual perspective. From a conceptual perspective, it's a relevant topic, right? Of course, the new syllabus has not examined this particular topic so far, but while we go through these things, when we spend time on different concepts, you will enjoy the conversation, right? You would really see that there's a lot of interesting stuff that lies when we discuss the different concepts under this particular topic. It's interesting again because there are a lot of calculations, there are a lot of measurement aspects required to be done, and we'll talk about those, of course, when we discuss this particular standard in detail. All right. Thank you very much.